Despite an empty economic calendar at the beginning of this week, major currencies may trade with increased volatility. This primarily applies to the Australian and Canadian dollars and the Swiss franc, as the central banks of these countries will announce their interest rate decisions on December 10, 11, and 12 respectively. By the way, the Reserve Bank of Australia is the only one among other regulators that has not yet started the cycle of rate cuts. According to forecast, it's not expected to do so in December. At the same time, rate cuts by other leading central banks seem almost inevitable. As for the Fed Reserve, according to the FEDWATCH tool, more than 85% of the market considered this possibility on early Monday. The remaining part believed that the central bank would pause and leave the funds rate at 4.75% in the meeting on December 17-18. However, investors are downgrading their bets on this dovish move. It seems that traders are pricing in a rate cut by the US central bank. On early Monday, the US dollar index, which tracks its dynamic against 6 major currencies, was trading at about the round support level of 106 points. Moreover, more and more analysts reckon that the US dollar is losing its bullish momentum, which had strengthened for 4 weeks following Donald Trump's victory in the presidential election. In fact, this past Sunday, he contributed to the dollar's decline. A real relief for the markets came with Donald Trump's statement that he would not attempt to replace Fed Reserve Chairman Jerome Powell. Apparently, one of the reasons for his positive stance was the US labor market reports, which exceeded even the most optimistic forecasts. The non-farm payrolls looked 227,000 new jobs in the US private sector. Thus, the US employment report became a sign of the still strong labor market and a reason for traders to lock in profits on the US dollar. This is why the euro managed to break free from the 2-year low of 1.0332, where it had plunged at the end of November. Another supporting factor for the euro may have been interventions by the Swiss National Bank, during which it sold francs for euros. The scale of a euro buying was so significant that it even managed to save the euro from parity with the US dollar. However, the euro will reach parity with the greenback sooner or later. And there is only one path for the euro, a decline. After all, its fundamental reasons will not only persist but, on the contrary, will be cemented. This includes the economic lack of Europe compared to the United States and the possible acceleration of inflation in the American economy, especially if Trump proceeds with the raising trade tariffs. The euro is also under pressure from political uncertainty in France, which is leading to capital outflows and a decline in business activity and investment. Therefore, the long-term downtrend for the euro remains intact. The same goes for the medium-term trend, during which the euro-dollar pair is set to move below the technical support level of 1.0450. Moreover, short-term forecasts also suggest a bearish trend for the euro. If the single currency manages to break through resistance at 1.0590 and hold about this level, the bulls will be able to push the investment to 1.0950. Oil prices are still responding mainly to news coming from areas of geopolitical conflicts. Now, Syria has been added to the mix. If the transfer of the power of his country proceeds relatively peacefully and the tensions in the region calm down, oil prices will likely go down as well. And if hostilities resume, the risk of supply disruptions from the world's main oil-producing region will only increase. In that case, oil prices will go up in confidence. Since early Monday, Brent crude prices have been trading lower in the range of $70.90 to $72.10 per barrel in the light of the OPEC decision. Although the cartel postponed increasing oil production for another 3 months, Saudi Arabia has lowered invoices for the Asian region, and this decision was primarily related to the persistent decline in demand from China. Besides, market sentiment worsened even more due to the unexpectedly sharp drop in the consumer price index in China. And this proved concerns that Beijing is not taking sufficient measures to revive the economy. Even the two-day closed-door economic talks announced by China's authorities this week are not instilling much optimism in the markets. Any major proposals or targeted investments to stimulate the economy will hardly be made. China may prefer to wait for the more clarity regarding the trade tariff hikes announced by Donald Trump. Meanwhile, the Russian ruble is gaining ground, trading at 100 rubles per dollar. However, this development contradicts the previously stated interests of the Ministry of Finance, which is more interested in a weaker ruble. And thus, in the near future, we expect further ruble interventions not only from the Ministry of Finance, but also from the Central Bank of Russia, especially if the ruble continues to strengthen by inertia. So that's all for today. We monitor developments in the financial markets, subscribe to our channel and follow news with us. See you soon.